Hello friends, last week in my video I told you that the bulls were attempting a comeback and what a comeback it was. This week I want to talk about whether the rally is likely to sustain, is it likely to continue, and there's a new segment for you in this video. 4 stocks that are likely to move the markets. I'm going to share these charts with you. These are 4 stocks that you need to watch. They have the potential to swing the markets in either direction. So let's dive right in and see what's likely to happen in the week ahead. Now, on the market roundup window, you can see that it was the bank Nifty that outperformed the Nifty 50, and the reasons are not far to see. We were basically expecting inflation to go down, food prices were coming down, bond yields were constant, and the US dollar index actually lost ground to the extent of 1.33%. One of the biggest worries about inflation was rising crude oil prices, which was reversed as crude oil fell. Silver fell a bit, whereas gold remained buoyant thanks to the safe haven buying, which was basically seen on account of hedging. Natural gas prices unfortunately rose pretty sharply, and the USD INR, that is the United States dollar versus the rupee on the National Stock Exchange currency derivative segment gained 0.04%. Had it not been for the USD INR being strong, we would have seen a far sharper rally. The NSE gained 3.62% in market capitalization, which is commendable. MWPL continued to rise, which is normal till the third week of any derivative expiry. And the US markets also saw a rally, a pullback rally, which basically helped the domestic markets to gain ground. Coming up on your screen now is the daily chart of the US Dow Jones Industrial Average. And what you are seeing is while the death cross remains in place and the price has moved above its 50-day moving average, the index has gained on 3 out of 5 trading sessions last week. And barring Friday, where we have seen a bearish piercing candle on account of worries, because of China. China is likely to remain a big concern. It's something that I have been posting very frequently on my Telegram channel. Please take the effort to subscribe to my Telegram channel. I keep posting a lot of stuff there. And the bigger trigger was the European Central Bank biting the bullet and raising interest rates by a whopping 50 basis points. And this is not something that the US was expecting, because for 11 years, the ECB, the European Central Bank, has not raised rates. Now, in order to attract overseas funds, the US Federal Reserve will be forced to compete with the European Central Bank and raise rates also, which is why it was a concern on Friday. But do note that the upper dashed trend line, the upper dashed blue trend line, which is the previous significant high, is still to be overcome. So we are still in a technical pullback territory, not a complete trend reversal. Let's now see the Nasdaq 100 daily chart on your screen. What you're seeing is a rising bottoms formation, but the previous swing high, which I've marked with a blue trend line, is still yet to be overcome, which means that the current rally is still a technical pullback. And the death cross is still not negated. The price, however, like the Dow, is above its 50-day moving average, which is a short-term relief for the bulls. The broadest index of them all, the S&P 500 on your screen, similar rising bottoms formation, but the previous swing high is yet to be overcome, which I've shown you with a blue trend line, and the death cross here also remains in place. So the US market did help the Indian markets, but still we are in the realms of a technical pullback alone. Now on your screen is the MWPL on a weekly time frame basis. What I am seeing, and this is something that I had told you in the retail options and futures exposure segment at the end of the video last week that risk appetite was rising, which is why I was saying that the bulls are attempting to make a comeback. Do note that the MWPL has risen to 28.59%. Of course, in the coming week, there is an expiry. So next Friday's MWPL will take a sharp nosedive. As you can see on the chart, it does every 4 weeks. But this level of MWPL is the highest after the expiry of March derivative series. So risk appetite is definitely improved a bit. And if MWPL continues to rise along with the price, the bulls will get bolder. Now for the index and stock futures turnover. This is a turnover on 3 concurrent series, which is July, August and September. What you are seeing is that the individual stock futures turnover has simply shot through the moon and it's at a 20-week high. That tells you that both the 1 and 2 Marshmallow traders participated in the up move. The index futures turnover also rose for a second week in a row, but it's not even in the median end of the 20-week range. What I am enthused about is that stock futures being a whole lot more volatile than index futures, retail traders are taking additional risk by taking bigger exposure to individual stock futures. Now, for the basis analysis, the basis is nothing but the premium or discount enjoyed by the future compared to spot. Unfortunately, the Bank Nifty has gone into basis inversion. Inversion would mean discount to spot. Now, that tells you that there was a lot of hedging and nervous profit taking at higher levels on the Bank Nifty. Do remember the Bank Nifty has outperformed the Nifty 50. So therefore, traders who take a hedged exposure to the market simply raise their protective hedges, thereby exerting pressure on the Bank Nifty. The Nifty basis remained just about positive. Do remember in the week ahead, we have a derivatives expiry where the basis contracts to almost zero on the expiry day, which is pretty normal. All we need to see is whether the basis remains sustainably in the negative. That would be a sign of concern. So keep watching this. I update this data on my social media accounts every evening. So please do connect with me. Now for the advanced decline ratio, this is the fastest and the best leading indicator of market turnarounds. What we are seeing is that for the 4th consecutive week, the advanced decline ratio has stayed above the 1 level. Last week, we saw marginal improvement to 1.14, but what is noteworthy is that on all days of the week, the advanced decline ratio was above 1. So, 1 Marshmallow traders are showing signs of improved conviction levels. Now for the impetus chart, which you've learned to rely on for the last 15 months or so, what I'm enthused about on the impetus chart is that the impetus of both the Nifty and the Bank Nifty has risen along with the price, which tells me that there was momentum in the upthrust and therefore the bulls have shown increased amount of risk appetite. In the coming days, what I do want is the impetus to rise along with the price, which would tell me that forceful buying is sustaining. Now for the LWTD chart, the Nifty percentage gain loss line is flatlining. That's the blue line. But the LWTD chart is falling deeper below zero, which tells me that in the coming week, there is a possibility of higher levels witnessing some amount of profit taking. Do remember, when both these lines are moving in divergent directions, it is the price that gets precedent. And here the price still remains above zero, but it's not rising. And the LWTD falling tells me that the situation is slightly cautious. Slightly. Now I take you to the footprint of the 4 market participant types. We begin with the FIIs who raised their individual stock futures net long positions, as you can see on your screen, and they've cut their index shorts aggressively, very aggressively, as a matter of fact. So the FIIs have suddenly taken a liking to the Indian markets, and they are creating long positions here. Where DIIs are concerned, they've basically increased their index short positions marginally, but they've cut their individual stock future shorts fairly aggressively. Why are they net short? Because DIIs are supporting the markets by taking deliveries in the spot segment, and they are hedging those buys with shorts in the future space. The fact that they are cutting their futures net shorts is by itself a positive sign. Now for the prop traders, these guys are brokers, own trades. They are second best to insiders because they know who's buying, how much, and at what price. They continue to cut their exposure very, very sharply. Now both their index and individual stock futures exposure is the most pessimistic in 20 weeks. In indices, they are the highest amount of short sales they have seen in 20 weeks, and they've increased their short positions week on week, whereas their individual stock futures long positions, they have reduced by less than half. That tells me that the prop traders are very, very cautious. Now for the individual retail trader who's been doing all the heavy lifting, by the sheer volume of his holdings, the retail guy can swing market prices by his buys and sells. And if he was to unwind his huge amount of long positions, that could create an impact in the market. What you are seeing is that the retail guy has cut his net long positions in index futures very aggressively by almost 2/3. And where individual stock futures net longs are concerned, their positions are back below 1 million lots again. Now, part of the reason could be the impeding expiry, but it goes far beyond that. Do note that this is a weekly chart, and since 3 months, the average retail long positions in individual stocks have tended to come down. Now, that basically tells me that on one hand, the prop and the retail guys are circumspect, are cautious about the market. On the other hand, institutions, both FIIs and DIIs, are feeling stronger. So it's a standoff between institutional and non-institutional players. The market is being dominated by institutions. Now, friends, the 4 stocks to watch and why. I start with Reliance Industries for the simple reason that if you see the metrics on your screen, Reliance has a weightage of 12.94%, which makes it the highest weighted stock. Its beta is 1.12, which means for every 1% rise in the Nifty or fall in the Nifty, Reliance will rise 1.12% or fall 1.12%. It has a higher beta than the index. The impact cost, remember I keep showing you the snapquote window, and I keep telling you keep monitoring the spreads, the bid and offer spreads, and the difference in prices between the best 5 bidders and best 5 offers. That is impact cost. Now, impact cost, the lowest across the market in the derivative space, in the Nifty and Bank Nifty constituents, the lowest is 0.02%, and Reliance enjoys 0.02% impact cost. So trading cost is minimal here. What we have seen is that the street was unhappy with Reliance's numbers. Reliance itself has given a guidance that oil refining margins and even oil prices for that matter may be headed lower on recessionary concerns. There is a possibility that there could be profit taking in Reliance. So if Reliance was to fall below 2,467 first, which is a minor support, and a bigger support is at 2,447, that would weaken the sentiments for Reliance, and because it has 12.94% weightage, it could drag the Nifty marginally. On the flip side, do note that if Reliance was to stay above 2,542, and these are spot levels, you would negate all the weakness, and due to the sheer weightage in the Nifty itself, it could pull the broader markets up with itself. Now, the second stock to watch, HDFC Bank. On Friday, what I saw on HDFC Bank was fairly enthusiastic buying coming in. It's been a while since I saw a near approximate 50 rupee move on the upside intraday basis in HDFC Bank. The fact that it has a weightage of 8.55% in the Nifty and it has a beta of 1.04 with an impact cost of 0.02% tells me that this stock has the potential to pull the Nifty higher with itself. And this is the highest weighted stock in the bank Nifty. So if HDFC Bank was to rise, it has an almost 1/3 of the entire weightage in the bank Nifty by its own steam. So it can pull the bank Nifty in the direction that it chooses to move itself. So this stock is extremely critical, in a way more critical than Reliance, because Reliance moves only the Nifty, whereas HDFC Bank will move both the Nifty and the bank Nifty with itself. Now, there are minor resistance levels at 1,410 and 1,420. Should HDFC Bank go past these and stay above these levels sustainably, you could see fresh power coming in to Nifty and bank Nifty bulls. Now, I come to Infy. This is a technology major and its weightage is 7.73% in the Nifty 50 with the beta or the volatility that it shows intraday being the highest of the four stocks at 1.6, which means for every 1% move in the Nifty, this stock will move 1.6%. That's why it's a trader's delight. And the impact cost is 0.02. So it's fairly cost effective to trade for a scalper or an intraday trader. Last week, I had recorded a video about why the rupee, a falling rupee, does not necessarily help technology stocks. You can now get the URL of that video in the description below this video in the pinned comment and as an end screen at the end of this video. The reason why I recorded that video was I knew because the rupee had made an all-time low against the dollar, a psychological level of 80 was breached. There would be a lot of high decibel noise in the market about how you should be buying tech stocks. But look at Infosys's chart. What you are seeing is a bearish engulfing pattern on the chart. That tells me that on Friday, the bears simply hammered the bulls pretty badly. But is it an end to the rally? Not necessarily. If Infosys crosses the 1,555 levels, all bearishness would be absorbed for a short term, and due to the weightage of 7.73% in the Nifty, this stock can help the Nifty go up. On the flip side, do keep watching the intraday low of 1,540 of Friday. If it starts to trade continuously below that level, then the bulls could be in for slight trouble on Infosys. Last but not the least, I go to ICICI Bank. Quite simply, the strongest chart of the four that I have shown you. With a weightage of 7.11%, it's fairly significant in the Nifty 50, and in the Bank Nifty, its weightage is fairly high. The beta is also fairly high, 1.4, which means it moves 1.4% for every percent move in the Nifty. Impact cost is pretty low, 0.02, can't get lower. What you are seeing is that it has taken out its previous swing highs. And in any market, when the bearishness is to be said to be conclusively over, you need to overcome at least one previous swing high. This has overcome both swing highs at 757 and 778. Now, in case the market comes down, if ICICI Bank's price comes down, the first support will be at 778. It's okay for the stock to come down to this level as long the bulls defend it and stop it from going further down. I think this stock can continue to help the indices perform fairly well. So there you have, friends. Watch these four stocks. You will be able to trade the Nifty and Bank Nifty far better. Now, for the bond markets, the very critical and most neglected area of the market, but I do cover it diligently. What you are seeing is a marginal decline on a week-on-week basis on this weekly chart. The bond yields fell, which means the bond prices rose a little, which provided relief on a mark-to-market basis on the portfolio of banks' bond holdings, which helped the Bank Nifty to rise. Do remember that the coming week is the final week before the Monetary Policy Committee of the RBI meets to determine the next decision on interest rates in India. So bond markets may be somewhat steady and quiet in the coming week, but in the week after that, you could see second guessing coming in from traders who will start betting whether the RBI will raise interest rates or keep them constant. Therefore, a lot will depend on the bond yields, even on the Bank Nifty's outlook. Don't let anyone tell you that bond markets are not important. Don't fall into that trap and axe your own foot. The bond market's done. I now come to the US dollar index, the Dixie, which fell 1.33% in the week gone by. It fell on 4 out of 5 trading sessions and tested its 25-day exponential moving average, as you can see on your screen. Do remember, friends, what I had told you last week. I told you that the price has gone way too far from its moving average and needs to come down in a mean reversion manner to the moving average, and then we'll take a call about what happens to the US dollar index. And there you have it. It's taken support exactly at the 25-day exponential average, which is a month-long holding on cost of an average bull. So for now, the very short-term outlook still remains optimistic but needs watching. For all emerging markets, including India, we need a weak dollar so that our imported landed price, especially of fossil fuels, natural gas and crude oil, is lower. If the dollar is expensive, everything that you buy, from your cell phones to laptops to imported clothes, shoes, etc., will become more expensive. That adds to imported inflation. So if the US dollar is falling next week, our market will rise higher. The weekly chart on your screen shows a very prominent bearish candle as compared to the previous week's candle. It's still not a bearish engulfing pattern though. But the price still remains fairly far from the 25-week exponential moving average, which is a 6-month holding on cost of an average bull. So there is still a possibility of the US dollar index coming down a little bit. Hey, good for Asia, good for emerging markets, good for India. So last week, I advocated a range between 109.80 on the upside and 106.20 on the downside, which was exceeded on the downside, admittedly, because the low was 105.99. So the Dixie exceeded my estimate by 21 basis points. In the coming week, I expect a range between 108.35 on the upside and 104.75 on the downside. Friends, the Dixie done, I now come to the Nifty 50, which was clearly the star of the week gone by. It gained 5.93%, gained on all 5 out of 5 trading sessions, and also overcame a previous swing high at 36,084. I bring up the daily chart on your screen, and as you can see, the previous swing high is overcome. The gap which is between two parallel trend lines is covered, and the recent a high of 35,543 has also been overcome. In case the markets were to decline, this level of 35,543 will be the first support that the bank Nifty will enjoy. This is the first thing that you need to watch out for. Now, the bearish trend line, which is connecting the top made in late October 2021 and then connecting the top made in April 2022, has been tested on the daily line. What we do need to see is whether the bulls can keep the bank Nifty going above this trend line. If they do, it opens up the doorway for the previous swing high at 38,759 to be tested. Whether it will or not, we need to see. Do remember the 4 charts I shared with you. On the declines, like I told you, watch the 35,543 level. Below that, the 25-day exponential moving average, which is a 1-month holding on cost of an average bull. And right now, the short-term outlook remains positive. Let's now see the weekly chart. The price is above the 25-week exponential moving average as well, which is a 6-month holding on cost of an average bull. This is the first time such a thing is happening after April. So welcome sign for people who are holding longs on the bank Nifty. And here again, the bearish trend line is tested on the weekly chart. The minor relief that I do see is that the 25-week exponential moving average is showing early signs of flattening out with a marginal tilt to the upside. It's too early to bring out the bottle of champagne and celebrate. We still need follow-up buying before you can go out there and pop the bubbly. In the week before last, I told you this index was number 5 on our in-house most volatile counters list. Last week, it rose 1 notch to go to number 4. That's pretty challenging for a retail trader when a frontline index this heavy is rising up in the volatility ranking. So do be very careful out there, my friends. Last week, I advocated a range between 36,275 on the upside and 33,100 on the downside, which was overcome. I proved short because the bank Nifty went to 36,825 levels. It exceeded my estimate by 575 points. In the coming week, I expect an estimated range between 38,375 on the upside and 35,100 on the downside. Friends, the bank Nifty done. I now come to the Nifty 50, which gained a spectacular 4.18%. I told you the bulls were attempting a comeback, and what a way they came back. They took the index up on all 5 out of 5 trading sessions. They also showed a gap up on the upside. That tells you that enthusiasm within the traders was fairly high. And like the daily chart on your screen tells you, the price is significantly above its 25-day exponential moving average, which is a month-long holding on cost of an average bull. So the short-term outlook is bullish. But unlike the bank Nifty, which has already overcome its previous swing high, the Nifty is yet to overcome its previous swing high of 16,794. We need to overcome this hurdle. Do note, friends, that in the recent past, it has been the bank Nifty, which has been leading the way. The Nifty has been rising overall, but it's underperforming the bank Nifty. So the money is actually going into the banking stocks. So therefore, we need to basically see that the Nifty has to go up above 16,794 and stay above that, which will then raise the probability of a further up move. Coming to the weekly chart, what we are seeing is that the Nifty has closed above its 25-week exponential moving average. which has happened for the first time after April. That's a good 3.5 months. Medium term bulls who are buying and holding are seeing sign of relief, which is a good thing. And we need to see whether these bulls are providing overhead supply by exiting, or are they holding on to their long positions, or maybe even adding, which would then take the markets higher. The 25-week exponential moving average itself is pointing marginally upwards, but like I said, early days yet. Don't get out that bottle of champagne, because it takes a couple of weeks for the weekly moving average to move. So we need to watch this space. In the week before last, this index was number 12 on the most volatile list in our in-house list. It jumped 5 notches and hit number 7. That's not funny at all. It's very challenging for a retail trader to encounter a market which is going more and more volatile. Last week, I advocated an estimated range between 16,650 on the upside and 15,450 on the downside, which was again overcome because the high it logged was 16,752, which is 102 points higher than my estimate. In the coming week, I expect an estimated range between 17,325 on the upside and 16,100 on the downside. Friends, I still suggest you trade light because volatility is fairly high and there is a lot of pull and push. China is worrying people, so are rate hikes across the world. And we also have a monetary policy committee meeting coming in the first week of August in India itself. So the undertone still remains optimistic, but it's always nice to be a little careful. Friends, the indices done. I now come to the new segment that I have started covering for you, where I show you retail risk appetite in terms of the percentage turnover contributed by stock options vis-a-vis stock futures. While stock options turnover has gone to the moon, you can see it from the line that's gone up sharply, the light green line. The stock futures turnover is also high on a week-on-week basis. Now, if traders want to play safe, they buy lower cost options. But when they are more aggressive, the risk appetite is higher. They say, okay, come on, give it to me. They spend more money. They invest more money rather by paying span margins and get into futures. So when futures turnover is higher, it says that risk appetite is coming back. Last week, we saw risk appetite coming back. This is something that I told you in the previous week's video as well. So should this continue, I expect the markets to be optimistic in the week ahead as well. Friends, I now come to the most popular segment of this video, wherein I give you 5 names which have gained the highest impetus on a day-on-day basis, where you take small exposure, wait for large price moves. And 5 names which have lost the maximum amount of impetus, where you take big exposure, wait for small price moves like a scalp trade. This list is valid only for Monday and Tuesday through Friday. The list is updated on my Telegram channel and via WhatsApp. So do connect with me and be included in the list of people who are far ahead of the crowds by knowing what to trade. The high impetus list is led by Hindustan Aeronautics Limited. The second stock on the item is PEL. Third one, Ultratech Cement. Number 4, Mindtree. Number 5, IndusInd Bank. The impetus losers list, where you take big exposure for small gains, is led by Torrent Pharma at number 1, Exide at number 2, Container Corporation at number 3, number 4, Delta Corp, and number 5, Balakrishna Industries. Like I said, the hierarchy of this list will change daily, so do connect with me to get updates on your mobile phone or in your Telegram channel. Friends, I bid goodbye to you in this video, not before reminding you to click like on this video if you liked what you saw. Subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put up out here. Good, bad, or ugly, I'm always looking forward to your feedback. via the comment segment. And help me reach out to fellow like-minded smart investors like yourself by referring my video to your family and friends and your social media groups. Help me reach out to bigger audiences. Thank you for your patience. I wish you have a very, very profitable week ahead. This is Vijay Bhambwani signing off for now till we meet again in my next video. Do take care. Bye-bye.